Friday, November 18th, a week after Election Day, and it seems maybe a little longer than that. Unusual discipline ahead. There isn't any way to talk about money, about interest rates, about budgets, about tax policy, about economic growth without talking about politics. One of the best American spirits is, after a campaign, especially a bloody one, it's in the American tradition that, okay, he won, it's over, to include assaults on character, no matter how accurate, are suspended when the election's over. And we wait to see how the person's going to do, what the person's going to do. And it's a good thing. We also have a tradition of, for the most part, forgetting whatever the campaign promises were. We should know that they're not going to keep them, but we're so attached to them that we hang on them until we're where we are. Mortgage rates have risen a ton. Long-term rates have risen a ton. They're both up a half a percentage point since last Wednesday morning. That's a lot. Mortgage rates are now just above 4%. And that rise we can tolerate. We've been above 4 repeatedly since the Great Recession began and lived to tell about it. We've also come back down after going above 4, which may be partly why we live to tell about it. And this time, big question, how much farther do we go? How much of this is Trump and how much of it's something else? And as the copy nearby beats to death, a substantial part of this rate rise was already underway. It had its sources in Europe and Japan, not here. Had nothing to do with Donald Trump, but the next leg is all about the Donald. In early Reagan, we enacted huge tax cuts in an effort to get the country out of a recession. And we had very high interest rates, partly as a result. We did it again in early Bush 1, which got us out of a deflationary patch and bridged the gap after 9/11. And the times that we didn't do it were principally early Clinton. And early Obama we did it to get out of the Great Recession. This time, the promises on the table are that Trump intends tax cuts to get GDP growth up to the 4% range or substantially above where it is now. And we also intend some very significant spending on infrastructure. This time around, there's a great deal more debt outstanding in the world and in the United States than there was all the other times that we went through this. A tremendous amount more debt. We are also much closer to the end of an economic cycle than the beginning. We have a very low unemployment rate. The Fed already feels the need to begin to raise interest rates. And if the new administration sails into this with an absence of fiscal discipline and a desire just to spend, whether by tax cuts or by spending or both, it's going to force the Fed to tighten faster. Markets are not going to like it. Interest rates are going to rise and likely rise faster than any stimulus comes out of Washington to increase economic growth. That's a prescription for a recession. I don't want to see that. I don't even want to talk about that. But where we are right now, that's what's on the table. That's why the market has behaved the way it has, at least half of this move. And now we go from one appointment to the next. Mr. Trump could put out the rate rise fire by doing what Bill Clinton did early in his administration, which was to emphasize fiscal discipline and make spending and tax deals with Congress. And what he got as a result were very low and falling interest rates and a very good 1990s. Mr. Trump, in the space of 5 minutes, could say that much as he intends tax cuts and infrastructure spending, we will maintain fiscal discipline. And secondly, that he backs the person of Janet Yellen as the Fed chair, and all things being equal, intends to reappoint her when her term is up in less than a year and a half. If he did that and then made it stick with proposals and appointments in the 2 months to come, interest rates would stop rising. I have my doubts about whether they'd go back down, but they'd stop rising. Now we wait. We've gone through the national security appointments this week. Who we see as Secretary of the Treasury may have more to do with mortgage rates next week than anything else that happens. Happy Thanksgiving.